Welcome back. This is Mortgage Sensei here. Third part of the crash course in regards to how to get a home loan. We're going to talk about funds. Funds, aka, which is also considered assets. Okay. Funds or assets is what we're talking about. So the first part we talked about credit. Second part we talked about debt to income ratio. Third part we're talking about funds. Now these are the three things you as a consumer, you as a borrower should be focusing intentively on, making sure you have high credit, clean credit, good looking credit, good payment history for at least the last 2 years ideally, as well as good income, qualifying stable income and employment. And now we're rounding off when it comes to funds available. Now, when we're talking about funds and assets, there's two main reasons that we're looking at funds. The first reason is cash due at closing. Okay. So first reason, cash due at closing. Now, cash due at closing is comprised of the following. Number one is your down payment. Okay. Now, a down payment is not necessarily closing costs. I know a lot of this stuff gets confused. Oh, cash due at closing, closing costs, blah, blah, blah. We're going to break each section down and explain it in a way for you to better understand what it is and how it's applicable to you. So when we're talking about a down payment is your investment, right? It is you taking your cash asset, your money, your currency, so on and so forth that you have, and you're converting it into home equity, right? So it's still your money, it's just in the equity of your house. The next thing is closing costs. Okay, closing costs. Now, closing costs is really the cost to acquire the property, the cost it takes you to buy the home. The closing costs can include the following. It can include a origination charge. Now, what an origination charge is, it's the cost that the lender or broker is charging you to do the loan, and they're getting paid directly from you. It's normally a percentage of the total loan amount. The next thing that you'll see sometime is discount points. Okay. Now this is either or. It may be there, it may not be there, but it'll help you understand, especially once we get into the section talking about the loan estimate and the closing disclosure. But discount points. What discount points is basically prepaid interest in order to get a lower interest rate, which will lower your payment and help you save more money over the life of the loan. So discount points is your decision. Sometimes it is you find yourself in a situation where, oh, they put in discount points on my loan and I have to bring that to the closing table. That's because the lender or the loan originator didn't structure your loan in a proper way up front, and now they have to go with a lower interest rate in order to help your debt to income ratio out, or there's a credit challenge now, or the market has moved, right? And now in order to make the loan work, you got to go with a lower interest rate, and now you incur discount points, or which may or may not have been discussed up front, but that's what discount points are. Again, it's prepaid interest in order to get a lower interest rate, in order to lower your monthly payment and save more interest over the life of the loan. The next thing here has to do with, let's go with title costs. Title costs, excuse me. Okay. The next thing is title costs. Now, when we say title costs, okay, we're talking about the cost through the closing attorney, through the title company. This can be the policy, the insurance policy that's through the title company, the settlement charge, the recording charge, the abstract charge, whatever the title company themselves are charging you in order to record the information and disperse funds out for the lender and record information with the county. The next thing that you have is your government costs, right? Your government costs. Now, depending on what state that you're in, this may be a little bit or it may be a lot, right? Here in Georgia, where I personally live at, Georgia is an attorney state. And in an attorney state, you have you have taxes that you incur that you have to pay towards the state of Georgia when you acquire a property or you do a loan in general. And these costs, they start to add up. Other states like Florida, which I'm also licensed in, they have dual taxes. They have state taxes, they have county taxes, that you have to pay in order to purchase the property. But some states, they don't have this tax, right? States like, what's the good one? Arizona has it, but it's not as severe. But there are states where the government costs or the having to do with the closing costs are a lot less. It's not as expensive, right? In addition to that, you have your, like I said, you have your origination charge, you have your discount points, you have your title costs, you have your government costs, and then last but not least, and I'm gonna put this in a section of its own, you have your lender costs. Okay. Now, the reason why I'm putting lender costs away from origination costs and discount points is for the following reason. Number one, origination charge is not standard. It really is not standard in regards to the loan process. As far as how I do my loans and I structure my loans, you'll never see an origination charge coming from me. In most cases, you'll never see a discount point coming from me, right? But when it comes to lender costs, you always see lender costs no matter who you're working with, right? And it can be as small as maybe, $50, $200, right? Or it can be significant. But when we're talking about lender costs, normally you'll see the following, right? You'll see the cost for processing costs, right? You'll see the cost for underwriting, writing. You'll see a cost for admin, right? You'll see a cost for credit report. Right? You'll see these costs, and sometimes there's a little bit more, right? But those are normally the basic ones, right? Now, again, when it comes to doing a loan with myself, I don't have a processing cost, I don't have an underwriting cost, I don't have an admin cost, right? So normally you'll see a credit report cost, the cost for the appraisal, you might have a work verification cost if your employer charges that in order to obtain that. But those are the costs that you normally see when you do business with me. Now, the last but not least, and it's not so much a closing cost, but I'm just going to put it out there. It'll be lumped into your loan. So you're not paying it out of pocket, but you'll see program costs, right? And I'll go into that more in detail once we talk about the specific programs, but just keep that in the back of your head. You'll see program costs, which will affect your total loan amount. Now, so we have cash due at closing, which includes your down payment, your closing costs, and we kind of broken that all down. This is the cost to acquire the property. And then last but not least, number 3, you have your escrow. Okay, escrow. Now, I'm putting escrow away from down payment, and I'm putting escrow away from closing costs due to the fact that when you're looking at your cash due at closing, it'll just lump it all together, right? But again, down payment is your investment, right? So let me write that there so we don't forget. Investment, right? Closing costs, cost to acquire the property, right? Escrow is protection. Okay, protection. That's what escrow is all about. Escrow includes insurance, which can be like your hazard insurance, your flood insurance, wind insurance. Is normally anything that's considered like an act of God against your home and damage it. And the premium pays out, or the policy pays out through the insurance company, and it pays you and or the lender to cover the mortgage, but pays you in order to get your home repaired and make sure everything is okay, get back fixed. Also, you have your property taxes. Okay. Now I put property taxes here, and I call that an insurance, right? And the reason why I look at it as a protection when it comes to property taxes, first things first, is if you don't pay your property taxes, what's going to happen? They're going to come take your house, right? So you want to protect your investment, right? You want to protect your equity. You want to protect all the costs that you pay in order to get your home. You want to protect your livelihood. You want to protect, your family, all the memories that you created within your home. You want to protect all of that. So you want to pay your property taxes. Also, pay your property taxes is what helps keeps the amenities in your neighborhood up. So we talk about schools, we talk about roads, right? Those are some quick ones that you can think about. But all of that comes through the property taxes that you pay on your home, amongst other taxes that you pay, sales taxes and income taxes and so on and so forth. Okay. Now, this is your cash due at closing. Again, down payment, closing costs, and escrow, right? This is the easiest and quickest way for me to sum up what that actually means. The other, when it comes to funds due at closing, let's get this going here. All right, so we talked about cash due at closing, right? The other thing that we'll talk about is reserves. Reserves, okay? Now, you have the cash that's due to acquire the property, right? And let's say after, you bring all the money to the table, your down payment, your closing costs, your escrow, whatever your cash that you do to acquire the property, you then have some leftover money sitting in the bank, right? Or you should, okay? You have some leftover money sitting in the bank. Now, this leftover money is what the lender will start to state as reserves, right? Reserves basically mean how many monthly payments. So we'll write this out. How many monthly payments you have in your account, okay? How many monthly payments do you have in your account? That is what we're talking about when we talk about reserves, okay? So let's use an example, right? You bought a property, right? And now your payments are $2,500 a month. Okay. Your payments is $2,500 a month. Principal, interest, taxes, insurance, and community dues, homeowners association dues. Your housing payment is $2,500 a month. Now, you paid your closing costs, your down payment, your escrow is all set up. You forked all that money out at the closing table. And now, after it's all said and done, you have left over $10,000 sitting in your bank. $10,000 in bank. Okay. Now, from here, $10,000 divided by $2,500 mean you have 4 months in reserves. Okay, 4 months in reserves. Okay, now, I'm not necessarily saying that you have to have reserves, right? Because everything is based off a risk assessment when the lender is looking at your loan profile, right? If you have, and normally reserves come into play when it comes to your credit score, right? Normally, the lower your credit score, the more you either have to show in reserves, or the lower your debt to income ratio can be. The higher your credit score, right, the less you show in reserves, or the higher your debt to income ratio can be. Or you're going with a program that requires reserves, and reserves can be 3, 6, 12 months or longer, depending on what the lender wants. Now, it's always best to take the time to talk with a professional, loan originator like myself, in order to make sure that you have all the money that's necessary in order to close on your home, whether that's cash due at closing and or reserves as needed per the program requirements or the underwriting requirements. And that covers it when it comes to funds, aka assets. Now, the last thing I want to talk about, let's talk about a bonus real fast. Let's keep a bonus because I know this is a question that's going to come up immediately. Okay. Now, when we talk about assets, right, we have cash value, right, or assessed value. Probably spelled that wrong, but that's okay. Cash value or assessed value, right? That's what we're talking about. Now, cash value means literally what it says. Cash, liquid cash. Think what's in your bank, right? What's in your credit union, checking, savings, money market accounts, 401ks, stocks, bonds, mutual funds, right? Roth, RA accounts, right? That's what we're talking about when it comes to cash, meaning that you don't have to, you may have to go through the process of filling out a form in order to receive the cash, right? But there's not really a whole lot that you need to do when it comes to converting it into cash or bringing it to the closing table, right? Now, banks and lenders, we like this. We like this. And I know I'll talk to a lot of clients and be like, oh, I got a car that I have free and clear. I have a boat I have free and clear. I have a home with equity in it, and or I own a home that's free and clear. And all of that is fine and dandy when it comes to evaluating your net worth. But when we're talking about funds that you're going to be bringing to the closing table or funds that you're going to be using as reserves, right? We want cash value assets. That is exactly what we're looking at. Now, when we talk about assessed values, right? Assessed values is real property or personal property. So real property can be homes, land, cars, boats, jewelry, so on and so forth, right? Anything where you could put a dollar amount on it. Now, can you use these? The technical answer is yes, but it starts to get expensive. What I mean by that is when you start using assessed values, right? And you're trying to convert these assessed values into cash value, right? Because you got to convert it. You can't just say, oh, I have this much in value here, and I want to use that as cash due at closing. I just want to bring a car and drop it off, right? You can't do stuff like that. So you got to be able to convert it from this assessed value into cash value, right? But there's a process. Normally, the process or the safest process is to have two, and I'll repeat, two independent certified appraisers for that asset, right? So let's talk about a car. Okay, let's talk about a car, right? And you go to CarMax. CarMax is a great one. You go to CarMax and you get an assessed value for the sale of your home or sale of your car. And then you go somewhere else. You get an independent appraiser that appraises your car. Then you sell your car, right? You can sell it to CarMax, or you can sell it to someone else. But you sell your car, right? Now you got a receipt, right? You keep a copy of the receipt. You can keep a copy of the two appraised value reports, right? You take the cash and you put it in the bank. That's good. Check. You can do that, right? When it comes to boats, jewelry, it all works the same way, right? If it's not a cash value asset, doesn't mean you can't actually use it. It just means you're going to be doing more legwork, right? And knowing that up front will make it a lot easier. So again, let's say you own a home. You own a home, right? And Nelson, I wanna liquidate my home, right? Either through a sale or getting a mortgage or a home equity line of credit or whatever the case may be. But I want to sell my home, right? and I want to use that cash from the sale of my home as cash value to the purchase of my home. You can do that, right? You sell your home, you'll get a HUD-1 statement, a closing disclosure statement. Cash comes through the title company. Boom, you're good to go on that aspect. You don't necessarily need an appraisal because it is handled through the title company and through the sale of the deal. Let's say you want to go get a loan in, right? You can do that. Now, mind you, you go get a loan out. That's an installment loan, so you're now affecting your debt to income ratio, maybe even affecting your credit, right? But that is something that you can do. I've done it before, working with clients before, and they obtain a loan on their home, right? Or refinance their property, cashed out on a property. They still qualify with the new loan in order to buy another home with a loan and use the cash from that asset, that appraised asset, and was able to close on their home, right? Or have the reserves that's needed. And that covers altogether funds that's available. The next thing that we're going to be talking about going forward is we're going to be breaking down different programs, right? We're going to be talking about the programs. We're going to start with FHA. We're going to go into conventional loans. We'll go into VA loans, USDA loans. We even talk about some non-QM products. We'll talk about private lending, commercial loans. Eventually, we'll get there. But we'll start talking about all of these programs and how you can utilize them, what you need to do in order to get qualified. But the key to all of these videos is always remember this, okay? When you go in and you're looking to obtain a loan from a bank or from a lender or a broker, which I'm a broker, right? You want to be prepared, right? Nothing's worse than walking through, want to get qualified for a home that you found and you love it and you want to buy it, and then you can't get the loan. It's devastating in most cases. In my 10-year career, I see it all the time. People are devastated, and a lot of people don't recover, meaning that they just throw their hands up. I'm just going to rent another year. 1 year turn into 5 years, turn into 10 years, and they never actually own a home, right? But if you prepare yourself and you understand what the bank and what the lenders are looking for, why they're looking for it, how you can go about the steps that's necessary in order to look bankable or look like a person that the bank wants to do business with, then you can greatly increase your chances of getting the home that you qualify in or want. Thank you again for tuning in. This is Mortgage Sensei. Please check out the links in the description here on my website, my submit an inquiry. This is where you can submit a form where you'll get in contact with me and we can have a free consultation. Be on the lookout for my published book, How to Buy a Home with a Loan. Link will be in the description and a bunch of other stuff, right? Please check it out. Tell your friends, tell your family about this channel. Drop any kind of questions. If you have a personal scenario that you want me to run through here on my channel, if you're open to the public, I'm open to using an artificial character at least. But we can definitely discuss using real numbers, give it a different name, and walk through the process of what we need to do. And we're going to go through the whole process, everyone, from the moment you start getting prepared all the way until you close and fund and you're sitting at the closing table and they hand you your keys. Mortgage Sensei, see you on the other side of home ownership. You have a good one.